You know how it is. Day in, day out, you're focused on sales, costs, the usual stuff. But then, a few times a year, these other accounting tasks pop up, right? Well, today, we're going to tackle those big annual financial events in Japanese bookkeeping. We'll turn those potential headaches into something super simple and manageable. Okay, picture this. A serious-looking envelope from the city office shows up. You open it, and, yep, it's a tax bill. Your first thought is probably, great, another expense. But wait, how do you actually book this thing? Where does it go? That's our starting point. Let's dive in and figure out how to handle that notice.
So first up, let's talk about one of the most common ones you'll see, especially if your business owns any property or even just some major equipment. I'm talking about the fixed asset tax.
And it all kicks off with this piece of paper right here, the tax payment notice from your local government. Now look, this isn't some surprise bill out of the blue. It's totally predictable, part of the annual cycle. But just because you know what's coming doesn't answer the big question, right? How in the world do you record it?
Well, the answer is actually really simple. I love this part. It's just one journal entry. You debit your taxes and dues expense account, and you credit cash for whatever you paid. Boom. That's it. A nice, clean, straightforward expense. Done.
Okay, so what are we even paying for with this tax? Well, the fixed asset tax is a local tax. It's on things like the land and buildings you own, but also other depreciable assets. You know, machinery, company cars, that kind of stuff. And the key date here is January 1st. Whatever your business owns on that specific day is what gets taxed.
So how much are we talking? The standard rate is 1.4%. That's 1.4% of the registered value of all those assets we just mentioned. Definitely a key number to plug into your annual budget and financial plans.
Now, here's some good news. You don't have to fork over all that cash at once. The bill is typically split into 4 payments spread across the year. The exact months can change a bit depending on your city, but a pretty common schedule is April, July, December, and then February. So yeah, you'll want to get those dates marked on your calendar for sure. All right, moving on to our next big annual event. This one affects every single one of your employees. It's the year-end payroll adjustment. This is the thing that makes that last paycheck of the year, well, a little bit different.
So you might be wondering, what's the deal? Why is the December paycheck calculation so different from all the others? Well, it all comes down to this. This is the moment where all the estimates you've been making all year long finally meet the cold, hard reality of how much income tax is actually owed. So, here's the core idea of this whole year-end adjustment thing. All year long, month after month, you've been withholding an estimated amount of income tax from your employees' pay. This final calculation figures out the actual tax they owe, and then you settle the difference. And you know what? A lot of the time, this actually results in a small refund for the employee. A nice little holiday bonus, you could say.
Now, this next point is absolutely crucial, and honestly, it trips up a ton of people. The year-end adjustment is based on the payment date. It applies to all the salaries you paid between January and December. It has nothing to do with the work period. So let's say you pay your December salary in January. Well, that payment then becomes part of the next year's tax adjustment. This is seriously the most important rule to get right with this whole process. Okay, next up, if your business is doing pretty well, the tax office isn't going to want to wait a whole year to get their money. And that brings us to our next topic, interim tax payments. So how do you know if you have to do this? It's pretty simple, actually. You just have to look at last year's tax bill. If your final corporate tax payment was over 200,000 yen, guess what? You're on the hook for an interim payment this year. And for consumption tax, that magic number is 480,000 yen. If you paid more than that last year, you're making a prepayment this year. Okay, so how do we record this in the books? Now, this is important. When you make this interim payment, you're not recording a new expense. Don't do that. What you're actually doing is paying down a future liability. It's basically like prepaying part of a big bill. So you'll record the payment against your corporate tax payable or consumption tax payable accounts. This just lowers the final amount you'll have to pay when you file at your end. Yeah, this really is the best way to think about it. These payments aren't some extra tax. They are, quite literally, a down payment on the total tax bill you're expecting for the whole year. Simple as that.
And all of this, the whole year of bookkeeping, it's all building up to the grand finale, calculating and paying your final tax bill.
The process is actually a really simple 3-step formula. First, you close out your books and figure out the total tax you owe for the whole year. Step 2, you subtract any of those interim payments we just talked about that you've already made. And step 3, you just pay the rest. That's it.
So this journal entry here, this is for your final corporate tax payment. It's the moment where you settle up. You're just paying the difference between the year's total tax and what you've already prepaid. You're paying off that remaining balance and closing out that liability on your books for the year.
And you guessed it, the logic is exactly the same for consumption tax. You figure out your total for the year, subtract what you've already paid in the interim, and this final entry is just you paying off the rest. It clears that liability off your books. Nice and tidy.
Okay, so corporate tax and consumption tax get all the attention. They're the headliners, but they're not the only ones you have to deal with. There are a few other local business taxes that you have to file and pay at the exact same time.
So these other guys, the business tax and the inhabitant taxes, they're handled just like we saw before. The journal entry is super simple. You just record it as an expense under taxes and dues against your cash account. And with that, you've officially closed out these tax obligations for the year.
So, what's the deadline for all this final stuff? Well, it's pretty straightforward. The moment your fiscal year ends, a 2-month clock starts ticking. You've got exactly 2 months to get your financial statements finalized, file all your tax returns, and, of course, pay whatever you still owe.
So when you boil it all down, what's the big takeaway here? None of these things should ever be a surprise. They're all part of a predictable financial rhythm. And once you get the hang of these few special, non-routine tasks, you can totally stay ahead of the game. It means your books stay clean, accurate, and, honestly, a whole lot less stressful.
And that brings us to one last question for you. Take a look at your own business calendar. Which one of these financial deadlines is coming up next for you? Is it an asset tax payment, the big year-end payroll adjustment, or your final tax filing? Because you know what they say, being prepared is half the battle. Thanks for tuning in.